Welcome back to our intermediate financial accounting class. In the last few segments, we've been talking about the statement of cash flows. We've talked about why it's important. We've talked about how it's structured. We've talked about FASB's goals with the statement. We've talked about the differences between US GAAP and IFRS. And now it's time to start creating a statement of cash flows. As part of creating a statement of cash flows, it's time we talk about the simplified version that we talked about in earlier chapters and a real statement of cash flows, or the way a company actually does it. So let me just mention three differences between the simplified version that you learned in your intro accounting class and early parts of intermediate and the real version that we're going to learn now. So number one, the way we gather information is different at this point than it was originally. What we were doing with our green water example and all the different calculations we've made since then was to just look at the balance sheet accounts. If the asset account went up, we assume cash went down. If the asset went down, we assume cash went up. If a liability went up, we assume cash went up, etc. But that's not real. There are a lot of things we've learned about that change asset account balances, liability balances, equity balances, etc. that don't have anything to do with cash. Which means when we do a real statement of cash flows, we can't just use changes in the balance sheet. We need to use our knowledge of accruals instead. So we're going to look at specific transactions that we know affect cash. We're going to look at our income statement and we're going to make adjustments that we know affect cash flows, or more importantly, don't affect cash flows, so we need to pull them out. We are going to look at our balance sheet numbers, but we're going to look in depth and we're going to check and see, wait a minute, this change, I haven't accounted for it earlier, does it really have a cash effect? That's the difference between what we've done as the simplified version to an actual method. Second, the way we present cash flow from operations is going to be different. Under the simple method, we've always done the indirect method. Why? Because that's what's most common. In addition, we haven't cared what order we list the adjustments in our statement of cash flows as long as they were there. We can do direct or indirect, as long as if it's direct, we include that additional disclosure. And we really should be listing our adjustments on our statement of cash flows in a specific order. So we need to have the non-cash items first and then have the change in working capital accounts. So we're going to clean up our cash flow from operations section from whatever to a nice looking statement that's organized in a way that's easy to read. And of course, we're going to allow that flexibility. If you want to do the extra work of reporting both the direct method and the indirect reconciliation, you can do that. The third item that's different now than it was in the past is we're going to require the disclosure of non-cash items. So our simplified version that we looked at in the past just ignored non-cash items. Now we're going to summarize those important items in the financial statement if we can, in the notes if we can't. Now what we've done with cash flows up to this point has been fine. Nothing's really been wrong. It's just been too simple. We've been doing a basic version, and it's time to do the real version. We're moving away from the cash flow with training wheels to a real ride to figure out what a cash flow statement really should look like. I actually had the opportunity at one point to talk with a manager of a regional firm and discuss with him what we were doing with cash flows. And I walked through some of what I had students do and the ways that we treated it and played around with it in my class. And he liked what we were doing. But his comment was, you realize that's way more simple than anything they will ever see in the real world. And I said, well, if you find an example that's simple enough that I can actually use it to teach, please send it to me so that I can actually use it. I haven't heard from him yet. He's still looking for something simple enough that it would work from a teaching scenario. So even now, doing a grown-up or an actual version, we're still shy of what a real publicly traded company's statement of cash flow is going to entail. There's just so much involved. But at least we can take some steps forward, make these changes, and feel better about what we're doing and know that we're getting closer to what really shows up in a statement of cash flows. That said, how do we make a statement of cash flows? Well, we're going to break it down into 8 steps. And I'd love to say, if you follow these 8 steps, it's really easy. It's not easy, but it's fun because we get to go back and look at all of this key information and how does it work and what are the journal entries and what happened to cash and what happened to other accounts, so we can fit all of this big puzzle together to get to the real cash flow number and make it show up in a way that really makes sense and is easy to interpret. So not easy, challenging, but fun, and also a great review of everything going on in our business. So with that said, let's take a look at these steps. Step number 1, we're going to figure out our check figure. What is our total change in cash for the period? Step 2, we're going to set up a series of worksheets that will allow us to summarize our cash flow information as we figure it out so that we're ready to build a statement of cash flow later. Step number 3, we're going to adjust for the cash effects of special transactions. These are transactions that we have made special note of as we've gone through the period, knowing that they would have big cash effects. And we're going to look at what happens to cash and what balance sheet effects they change so that we make sure we're ready when we do dig into the balance sheet to make sure that we don't capture something that's already been taken care of. Step number 4 is to adjust for the non-cash items that are on the income statement. We want to get those non-cash items out of there. Step 5 is to adjust for the cash effects of changes to balance sheet accounts. So we're still looking at, did the asset go up or down? What happened to cash? Did the liability go up and raise cash as well? We're still looking at that. We're just going to do it in more detail, taking into account the special transactions from step 3 and the non-cash effects from step 4. So we're looking at it in a lot more detail and a lot more carefully. Unfortunately, with our example, we're still going to have to just assume some things. In reality, if we found something we thought was cash, we'd go back to the journal entries and we'd look and make sure it was really a cash effect. So that's one difference between what we get to do and what a real company would do. But these 3 steps are the key to everything that we're doing with the statement of cash flows. They're very different from what we've done in the past. In the past, we've just done step 5 and just assumed any changes in the balance sheet accounts were caused by cash. Now we're putting these 3 steps together, and they're so important that understanding these 3 steps and the fact that we do what we know first, then what we know is non-cash because we know enough about accruals that we can pull the non-cash out, and then we look at our balance sheet to see if there's anything left over. Understanding these steps and why they flow in that order is another of our key concepts. Step number 6, we're going to finish off the worksheets that we've been filling up with information, and we're going to make sure in step 7 that the sum of the balances from our 3 worksheets matches up with that total change in cash from step 1. If it does, we can do a statement of cash flows and any supplemental disclosures. This is the reconciliation of net income to cash flow if we decide to use a direct style statement of cash flows, and also any non-cash transactions that need to be disclosed. Now, the best way to really learn these steps is to actually do an example, and we're going to spend the rest of our time together talking about cash flows, walking through a comprehensive example. As we do so, we're going to be pulling from information on all the stuff we've discussed in Intermediate Part 2, stuff you discussed back in Intermediate Part 1. We may even hit some stuff from your introductory class, depending on where you took it and who taught it, and pulling it all together to create this statement. This is so much fun to see it all come together like this. So let's take a look at this example. Because there's so much involved, I haven't provided the information here, but the information is available to you in a template you can download to Excel from our class website, or if you're not in the class and you're watching this just because you want to learn about cash flows, then there's a link down below that you can use to access this information and move on. So before we go on, please take a minute, make sure you have that template on your computer and ready to go so that we can move forward. Now, using the information that you just downloaded and have on your computers now, and that I'm going to pull up here in a second in my Excel file, we're going to create a direct method statement of cash flows. We haven't done that before, so it will let us practice this method. And in addition, since we have to do the disclosure anyway, showing net income being turned into cash flow from operations, we'll actually practice the indirect style as well. So we kill 2 birds with one example. With that, I'm going to transition out of PowerPoint and into Excel so we can start working on this example. So this is the template that you should have downloaded. We have it set up with the balance sheet information here on the left. If you keep scrolling down, you'll find the income statement information and then a set of additional information. These are the notes that we've made about important transactions that have occurred during the year. So this is the information for step 3 of our statement of cash flows. In addition, you're going to find in here some basic helps so you can keep up with our discussion. You can see step 1's calculation, the different specific transactions all lined up with space to do some calculations for step 3. If we scroll over a little bit further, you'll see our worksheets. And then finally, if you keep going even further to the right, you'll see a basic statement of cash flows set up and ready for you to build when we get all the other information gathered. Now, fair warning here, I'm not going to follow this template. I've got to set up my work so that it's easy to see in these videos. So things aren't going to match up exactly, but hopefully you should be able to follow along and still do all the calculations. I'm going to try to go slow enough so that if you want to build all this by hand, not the income statement and balance sheet, but everything else, you can follow along and build it with me from scratch. I don't really recommend that. I think it's best to use the template so you can go a little faster, but it's entirely up to you. Now that we've looked at the numbers, we've seen the template, let's jump right into our analysis with our very first step. And our first step is to compute the total change in cash for the period. And to do that, I'm going to compare the ending balance in year 6 with the ending balance in year 5. And you can see that I've already set this equation up to calculate, but basically I'm just taking the ending balance minus my beginning balance. Our total cash flow has dropped almost $600,000. Now that's not necessarily troublesome because we're a big company. I mean, $2.2 million in cash. That's a lot of cash on hand compared to our current assets. So the drop is probably not too concerning, but it gives us a starting point. I want to make sure that I end up at this number when all is said and done. Now we're going to go ahead and stop right here. When we come back, we're going to start setting up our worksheets so that we can keep these segments at a manageable level. Again, the rest of our time together on this discussion of cash flows is going to be building this statement of cash flows for Avery Arrowheads. We want to make sure that we get it looking good, working perfectly, and use it as a great example of how we pull all of this stuff together to create the final set of our financial statements. So the fun's going to continue as we move forward. Make sure you're comfortable with the Excel and the template. You've looked through the numbers so you're ready to jump right into this when we come back. We'll see you then.